Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. In January 2025, I released an episode of Supernatural Stocks that asked whether Africa is uninvestable. Now, looking back on it today, that notion will probably sound ridiculous because Africa was a source of fantastic returns in 2025. But was this because the risks suddenly disappeared, or was it because there was a seismic shift elsewhere in the world that actually gave Africa a break? And what can we learn from this? Let's look back on the past year of company performances in Africa and why things have gone the way they have. We begin with a quick recap. The underlying thesis of that podcast last year was that Africa was not generating the returns needed to compensate for the risk on the continent. This is investing 101. If the risk-adjusted returns are not there, the capital will not flow. I pointed out that during the lost decade in South Africa, when capital was heading for the exit at every opportunity, FMCG and retail groups were expanding in Africa and trying to get a foothold in key markets, and the results unfortunately were disastrous. There are a couple of exceptions, but those wounded companies have largely returned home and are now doing well thanks to a focus on winning in a market that they actually understand, with perhaps some limited exposure in Africa where it still made sense to keep it. Shoprite is a very good example of this. So yes, Africa is tough, but the particular frustration at the time of that podcast was the extent to which own goals by African governments were creating additional risks. At the time, the podcast was triggered by the news of an unexpected export duty on emeralds in Zambia, absolutely crushing Gemfields' business at the worst possible time. That export duty didn't last long, it was dropped a couple of months later. But it was a nightmare in Zambia that came shortly after Gemfields also had to deal with mine invasions in Mozambique at their ruby mine, coupled with broader security concerns in the region. The TLDR is that Africa is hard. Gemfields is currently trading roughly 20% below the levels at the time of that podcast, as prices for emeralds and rubies just haven't been strong enough to drive a recovery. With diamonds as perhaps the ultimate cautionary tale in the sector, there's really no guarantee at all that prices will move higher and actually give Gemfields some breathing room. Now there's a lesson in here about buying mining companies in Africa. The layers of risk are incredible. Not only are you having to deal with all of the stuff that makes Africa difficult, corrupt governments, security risks, ever-changing laws and taxes, but you're also exposed to the underlying commodity itself. Of course, that isn't always a bad thing. In the first few months of 2025, Alphamon's share price approximately halved. The tin miner had to temporarily cease operations due to security risks in the DRC. It was another excellent reminder of how African markets can literally just chew you up and spit you out. But unlike Gemfields, Alphamon has pulled off a fantastic recovery since then. The share price is all the way back to where it was in January 2025, which means those who bought the dip of all dips there have actually doubled their money. This isn't because the risks are gone. Security risks are never gone in these regions. It's because the tin price is trading at multi-year highs thanks to explosive demand in the AI sector. Yes, tin is critical in data centers, not just the food aisle at your local grocery store. I will take you back to Investing 101. The market cares about risk-adjusted returns and nothing else. With tin prices flying high, investors are willing to take a risk on Alphamon. They know that the conflict could flare up again, but they can also see the momentum in tin prices and what that means for EBITDA. The price-earnings multiple at Alphamon is around 7.3 times at the moment. It's a whole lot lower than that on a forward basis, provided that the tin price momentum does continue, and of course provided that nothing else goes wrong, which in Africa is never a certainty. Gemfields and Alphamon are mining companies that have very focused exposure. They operate in specific regions and they sell specific commodities. As you can see from the share price performance differential over the past year, concentrated risks drive concentrated outcomes. But there is another way to play the Africa theme, and it was the right move in the past year if you did it. Sometimes you need to find companies that are just great proxies for a macroeconomic shift, rather than a specific commodity or product. It's important to have strong views in the market, but you must be willing to change your mind if new facts come to light. Trump only took office in January 2025, so it really wasn't clear at that stage just how much of an upheaval he would cause in developed markets. Trump's strategy to reset the playing field between America and regions like Europe and China meant that African currencies were thrown a lifeline. The dollar had been absolutely obliterating currencies like the Nigerian naira in 2023 and 2024, with companies like MTN Nigeria quite literally on the brink of disaster. And then all of a sudden, things changed. Instead of weakening rapidly against the US dollar, those African currencies, they actually started appreciating. The rand is no exception, as we know. And when a snake gives even the smallest chance of escape to the impala that it has in its grip, that impala is going to do everything possible to wriggle free and run away. And that is exactly what these currencies did. In the telco space, this change in trajectory for African currencies meant that capex budgets and foreign-denominated debt were no longer a disaster. In a stable currency environment, you can actually plan accordingly, even when the currency has stabilized at weak levels. This is exactly why MTN has more than doubled since January 2025, as the group has extensive exposure to Nigeria and Ghana. Vodacom is up more than 40% since those levels, with things looking up for the investment in Egypt. Vodacom's East Africa plays were never in as much trouble as the economies in West Africa, that's their businesses in Kenya for example, hence the share price hasn't been nearly as volatile as MTN over this period. Now, I don't mean to discount the role of management teams here, as they are obviously having to make decisions all the time to respond to opportunities, but I think it's clear that the primary driver of the rally in these telcos has been the macroeconomic improvements. A less dramatic way to play the theme would have been certain banks. Standard Bank especially comes to mind here, as they generate 40% of headline earnings in their Africa region's business unit. Even without dividends, Standard Bank has returned well over 30% to investors since early January 2025. ABSA also deserves a special mention here. Their Africa region's unit grew earnings by a casual 51% in the recently released results for 2025. And this excludes the activity within the corporate and investment banking business, where Africa contributed 5.5 billion rand in headline earnings, versus South Africa at 7.5 billion rand. The banks have been given a boost by Africa, but they are far from being a pure play on the region. In both those cases, South Africa contributes more earnings than the rest of Africa. And this is why the telcos had much more of a reaction to what happened in Africa in the past year than the banks. There are two major lessons that we can take from this. The first is that being willing to adapt to a change in the environment is critical in the markets. In January 2025, Africa looked like it was crushing any companies that came near it. But then we found ourselves in a new world, and Africa began to shine. Being stubborn is foolish in the markets. If things change, you do need to change as well. The second lesson is that there are many options on the risk spectrum. Even within a broader theme of, say, Africa, you could go for the riskiest plays and take a punt on the mining houses. Or you could take much less risk by buying the banks that have significant exposure to Africa, but also plenty of exposure elsewhere. Or you could dance somewhere in the middle and buy those telcos. Now, this is true for practically any investment theme that you can think of. The beauty of the markets is that there are many different ways to play. It ultimately comes down to where you are most comfortable on the risk spectrum. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.